Hi, welcome back to another episode of the South Texas Business Lawyers South Texas Power Lunch. Today, we've got a great episode to talk about something that hopefully every small business owner, startup will experience, which is selling their business. Or maybe you're looking to acquire a business. But some of the biggest things that we do here at the South Texas Business Lawyers is help our clients buy and sell companies. And today, I've got Malcolm Peace from Tsetserra Growth Partners, we're gonna talk through what it takes to get a deal in principle agreed to, whether you're buying or selling your business. And in this, we're gonna talk about some of the key concepts that I educate a lot of clients on how they should go about trying to create a deal, because it doesn't end when a lawyer comes on the scene and puts it on a piece of paper. It really begins way back when there is an initial conversation between a buyer and a seller. And we've got Malcolm Peace here that we're going to bring on right now that's going to talk to us about how we can go about getting that deal on paper. Malcolm, are you there?
Hey, Matt, thanks so much for having me.
Yeah, great to have you here. So, before we get started into all of the concepts we're going to talk about today about getting a deal on paper, let's talk about Tsetserra Growth Partners. Tell us about your company and what you guys are doing up there in Austin.
Thanks. Yeah. So we buy blue collar industrial type businesses in Texas and we add software and standard operating procedures to help them grow. So we are specifically looking at those that are blue collar in nature, industrial type businesses. You think the landscape kind of guy to the manufacturing to the bridge installation to the survey company, anything where people are doing hard labor or potentially sophisticated opportunities for value add to a society or something of that nature, things that make the world work. We like to look at those types of business because we think there's a real opportunity to add value.
So you guys are out there in the marketplace acquiring a lot of these type of companies and helping them go on to the next level. Is that right?
That's right. Yeah. So we have a belief that businesses at this size, we look at anything doing $3 to $12 million in revenue in Texas that's been around longer than 10 years. Any of those deals tend to have the business owner in the middle of them because they were the key sales guy or they knew operations or they were the tradesman at one point. And we ultimately look to be able to come in and change that by bringing in systems and processes to help that business kind of get out of what I like to call a centralized business centered around the business owner to a more decentralized business. So it's quite an abrupt change for some of the employees, I'll be honest, but it's necessary for the next phase of the business to grow.
Well, and I would assume most of these businesses that you're talking to, I mean, these are people, blue collar workers that have put in a lot of, sweat and tears and probably even some blood as they've grown their businesses. And they get to be to the size that really there's a decision that most of these owners have to make, like, is what's next? Because businesses with success can come, more money, more problems is what they say, right? You guys are really that solution where somebody can take an exit, continue along with their business, I would assume, and be able to get to the next level, right?
Yeah, that's absolutely the case. It is a challenge, and don't get me wrong. I think anybody that's been able to take a business from 0 to 7 figures, more credit to them. It's a harder job than what we do, in my opinion, but it's a slightly different skill set, right? It's a different ability, and subsequently there's another set of abilities for those that are bigger than us. So I often look at like, hey, we're a small fish. There was a micro fish, there's a small fish, there's a medium, large, and so on and so forth, and subsequently they have different skill sets to basically operate in their own ecosystems.
Which is fantastic. I mean, and that is a perfect example of the type of clients that we deal with, these small, medium-sized businesses that are looking for these type of exits. So we really appreciate you coming on and lending
Sure.
your expertise to this conversation as we really talk through, I guess, the beginning process of how someone, either as a buyer or a seller can go out there and approach a third party or react to a third party with regard to getting a deal done. When you guys are out there looking for deals, how do you identify deals that meet what you guys are looking for?
Yeah, so I don't think deal sourcing is any different than any other sales process. There's a funnel to it. There's a matter of cultivating some level of energy at the top of the funnel that's kind of broad sweeping and communicating, over and over again, like this instance where we just say, hey, this is what we're looking for. If it meets anybody's current business or so on and so forth, we would love to be able to entertain a conversation. You know, after that point, people go down the funnel where they've identified, hey, I really do want to sell, or I'm motivated to sell, or I need to sell, or so on and so forth. And allows us to then kind of get a better sense of like how serious are they to make the rest of the journey. Because as you're well aware, getting a business sold and across the finish line is by far the hardest process of this whole thing. It can be enduring to, be able to, talk with this business owner and work with them. But at the end of the time, being able to get everybody on the same page and have the emotional things kind of keep in contained and be able to get across the finish line is a feat for everybody to do collectively.
Absolutely, absolutely. And so, I would assume that part of, what you guys do is you build relationships, right? Because in that deal sourcing for you as a buyer of businesses, some people you talk to, I'm sure, are not ready. But that
Yeah.
relationship for the time where they are, maybe they aren't ready, or maybe they're not quite ready for what you're looking for. But relationships are key. Is that right?
Yeah, that's totally the case. And in many cases, it ends up being a circumstance of we know that we're starting a relationship now, and in time, you'll get to a point where you actually are ready to sell. I never want anybody to have to sell out of pure necessity. Often is not the good outcome for everybody. It feels rushed, or it feels highly emotional, or whatever the case may be. So I like to be in a position where everyone feels good that they walk away. I hate to be at that closing table and someone doesn't feel like they got a good deal at the end of the day. So yes, to answer your question, it is a long-term relationship. It's many times sitting in the living room with the golden doodles crawling all over you. True story. And you got to continue to have the conversation, knowing that you might not, be able to buy from them or buy their business in the next year or whatever. So, that to be said, yes, it's a relationship game, and it's usually a long-term one that takes a while to kind of get to that point.
Well, and that's important you brought up. I mean, distressed assets, distressed sales, they're very different than the process we're going to talk about today, because speed becomes a necessity, risk is different, and then pressures are out there that are very different. So I'm glad you brought that up, because as we talk through this process and continue down this, we're really not talking about distressed assets or a distressed purchase, or sale, because they are different. But let's get to where you have identified what some people, from a legal standpoint, the first time that I will hear from people is, hey, I got this NDA, which stands for non disclosure agreement. I don't know what I'm supposed to do with it. Can you take a look at it? That's really the beginning of what is business diligence for people like yourselves as buyers of businesses. Look at, explain how you guys approach business diligence and that first step of trying to understand a business on whether it's a good fit for you or not.
Yeah, I mean, we have essentially, qualitative and quantitative aspects that go into the deal. One being that does it fit kind of the overall metrics financially for the business? We look for businesses that are doing north of 15% on net margins. That's incredibly important because this business is going to go through a transition point ultimately. And when it goes through that transition point from, previous owner to us owning it and so on and so forth into the future, it ends up being, a circumstance of can this business make that transition? Is there enough smoothness in the business? If we have a lot of volatility going up and down, it can be a challenge for this business to transition really well. And it becomes even more complicated when we talk about working capital. So, all that to be said, that's kind of the aspects of the financial. And then on the qualitative side, it's a matter of can these people that we're going to be ultimately becoming a teammate with, can they make that transition to think about where the business needs to go to reach that goal that we have in mind? We like to double revenue in 2 years. That's the goal I like to talk about. If I can double revenue in 2 years, it's a slam dunk deal. But if I fall short from that, it's still a pretty good deal. And so we
Right.
try to set the parameter, set the expectation of that's where we're heading. And if that's the case, you make different decisions along the way as you're evaluating a deal, as you're ultimately looking at, what the team is capable of doing in its current structure. So qualitative, quantitative, there's all these aspects that go into it on the due diligence side. Happy to speak more to it.
Yeah, I mean, I guess for the people that are watching with regard to a non-disclosure agreement, this part is, the non-disclosure agreement is what keeps the different parties' information confidential,
Yeah.
right? So, as part of your quantitative analysis, you're going to want to look under the hood and see the financials.
Yeah.
If there's intellectual property or some sort of, secret sauce that they have, that's got to be protected, for those type of things. One thing I do tell everybody everybody is, early on in the dating phase of selling your business, the fewest amount of it, the least amount of information to get the buyer to the point that they feel comfortable at that phase is probably the best. To be able to make sure you get some deal points, because as we'll talk about in another episode, when you actually are doing the final deal and moving to getting an agreement in place, the diligence takes it to another level.
Yeah.
How do you guys look at kind of that initial discovery, it's not discovery, that initial diligence versus later on diligence as you're trying to get the deal closed?
Yeah, I think these conversations are so beneficial because we come from two different perspectives a little bit on this one. So let me put it this way. I think one of the biggest challenges for a small business and the size that we look at is there are a lot of people that just can't get the deal done, but will inquire about buying the business. And I think it's
Mhm.
hard for a business owner to discern, is this actually going to get done or not? Can they get emotionally attached to the idea of this person becoming the new owner? All those types of things play into this. And so it becomes a big, game of figuring out, how this all works. But all that to be said, I personally try to encourage an owner as we're going through it is like, rather get out some of the skeletons now so that we're not surprised later. And then we have this awkward conversation of like, hey, what you thought your business was worth and what it actually is worth as we go through this process gets beaten up and torn apart over time. And so, from a due diligence perspective, when you're kind of signing an NDA, I'd like to get some real understanding of the business. You don't need to give me every single thing. I don't need to be able to know every single one of your suppliers by name, all that kind of stuff. But I need to get a sense of like, hey, there is a big behemoth of a customer that you have had for the last few years, and you have a personal relationship with them, and all this kind of stuff. Like that stuff matters because it's going to show in the long run what the risk tolerance is for that buyer or myself to be able to take over this business and manage it. And then as we move towards an IOI or LOI, depending on the circumstance, let's get some of this out in the open to do that. So it's always this tight balancing act of, an owner is ultimately wanting to get a deal done, and so they have to entertain some frogs to find their prince, but at the same while, they don't want to give away everything where it ends up being a circumstance of like all their, everything out of the closet is out in public. So I know that's a fine line. I personally try to say, hey, I don't need to know all these things, but I need to know the following. And let's try to get that done. And then we can at least have a real conversation.
Yeah, no, I don't think we're that far apart. I mean, from a financial nature, right? I mean, that's something I think is pretty easy to do. One of the things I've realized, in dealing with small and medium-sized business owners, especially if they've never done a deal before, right? The whole process is new to them.
Yeah.
You and I understand that, like, related party transactions or, key suppliers, key vendors, or things that we work through in the secondary part. So those are discussions that I think are appropriate. Mine were more of the, some of the, internal secrets that, hey, we'll tell you later on. Or to
Yeah.
be quite honest, another thing that I've seen, about 6 months ago was, the introduction of the potential buyer to the workforce.
Yeah.
Which I think those are too early, where they want to interview employees and those sort of things, where it's like, there's a time and place for that. Not at the NDA stage is more what I
Yeah.
meant.
Yeah.
Um,
I think those are all those things are definitely post LOI, getting into it a little bit more. And again, that's part of the negotiation process, right? If you're going it with an owner and you're looking at it from my perspective, it's how much information can I get to feel comfortable around the deal, and vice versa. In some cases, it's like, how long do I want to feel comfortable that this person's actually going to get it done? And what information do I want? We have opportunities where we have to show proof of funds. Like that's a necessary thing from the returning side, what they want to know, how likely is this going to actually get done, because they don't want to have to expend the time and energy and resources and confusion for the team, and subsequently we don't either. So I totally get both sides.
Well, and that's another, eye opener for a lot of people that are selling their companies is cost.
Yeah.
I mean, when a term sheet comes in, whether it's been a long conversation, most of the time it's a short conversation.
Sure.
Somebody throws it on the table, to be, quite blunt on that one. But they see the dollars, right?
Yep.
Oh, okay. Somebody's going to spend, a million, a couple of million to buy my business, but there's still a cost to get to that finish line. And
Yeah.
one of the things I realized too, and something that I think small and medium-sized business owners miss is, if you are positioning yourself where you think you want an exit, or it's something that's in your mind, the more organized, the more legwork you do ahead of time can be better process, which is cheaper process. So that way you leave with more money in your pocket. I mean, I've had a client, and been in deals ages ago, where they didn't even really have financial accounting, even though they were out there with hundreds of accounts.
Yeah.
The business was good. You could tell from the bank account because they were putting it all in based upon debits and credits.
Yeah.
Ooh, this thing's got money. But when it comes to quality of earnings and all those sort of things, which we'll talk about later on, I mean, you're basically having to start from scratch, and it's costing a lot of money to do that. Do you see that a lot in dealing with your target, where there's maybe that lack of process and lack of organization?
Yeah, so I specifically spoke to, the fact that we spend time working on software implementation and standard operating procedures in these businesses, because 9 times out of 10, and maybe I'm jaded at this point, they are missing that fundamentally. They maybe
Right,
use a QuickBooks or some sort of accounting software, maybe they have some kind of bidding software or some kind of project management software, but by and large, there's no CRM, there's no sales process, there's no reporting, and there's no KPIs. And so as a result, it's very hard. I've got to switch the mindset when I'm evaluating the business, to your point about credits and debits and actually coming into the account cash.
right.
I've got to switch the mindset of like, I would love the following information to make a very good understanding of, should we proceed forward with this business, but that information is just not available. So how do I, make that shift? How do I communicate in such a way to an owner that maybe has never had that exposure or experience, doing that kind of information? Like, what do you measure your sales guys by? Like, they've never maybe considered that. I got to shift the conversation to be able to, one, that we can relate and communicate to one another, so I can get enough information, feel comfortable, and they, again, don't feel overwhelmed, because it is a lot. It's a lot of preparation. It's a lot of documents. It's a lot of getting it all kind of in order, to do so, and often is underestimated along the way.
It is. And from a lawyer's perspective, the lawyers argue when they actually are papering the final deal is risk allocation.
Sure.
And so, the challenge, for representing a lot, I mean, I represent on the buy side and on the sell side. I'm all over the place with that. But when I'm representing on the sell side, to a third party and having to make certain risk allocations regarding quality of earnings and those sort of financials, if things aren't organized, that makes that a really hard negotiation, to be able to do that. And it's not because people are being difficult, it's just because the reality is, if there's an unknown, somebody's got to be stuck with the risk of the unknown. And when you're selling your company, most buyers are going to say, well, but that's on the seller because they know more than I do. I don't
Yeah.
know, I'm buying the business. So a lot of organization and those sort of things, I'm sure, helps you out. It also helps your lawyers out too, when you get down into the process.
It reduces stress, cost, and all the above for everybody. Yeah, if we can get it done. Again, like, full disclosure, I feel empathetic, because often in these cases, in the businesses I'm working with, it's a business that's been around longer than 10 years, and as a result, this could be their largest asset they ever sell. And so
Right.
there's a lot of education that has to happen, and sometimes in a short period of time, and sometimes, they may or may not have the best support. And so, anyways, my approach is like, I want you to feel like it's well done on your side. So as a result, it's an easier process for me. I've worked with business owners that have hired their family attorneys, and I've signed 3 different versions of NDAs by the end of it, and all this kind of stuff. And so it can just get a little wonky, right? Like, it's a very messy, kind of grayish, kind of sphere of things going on, that everybody needs to understand that we're all coming from different point of perspectives. And as a result, like, the end goal is the same. We're trying to get this across the finish line, and we need to communicate through all the messiness.
Oh, God bless you, Malcolm. I mean, maybe we have to have another episode on family businesses, and the dynamics of those. I represent some amazing families, and those of you that are watching, I love you dearly, as clients, and consider myself as part of your families in most circumstances. But wow, that's a lot sometimes when you're dealing with those. But no, I get it. I mean, that's the market, right?
Yeah.
Let's shift now into maybe like a high level deal structure. And again, I don't want to get too wonky, because the reality is every single deal I've ever done, no two have been the same. There's always some sort of subtlety. The most simplest deal is, here's cash, we take your business.
Yeah.
And that happens, from time to time. But I would assume for a lot of your acquisitions, you guys are, you're buying companies that are owner operated, and you're going to have continued operations, even though there's an exit event. How do you guys typically look at deal structure with regard to those type of situations, which are pretty typical in the small medium sized space?
Yeah. So for context, a lot of the business owners that we interact with are doing 750 to 1.25 million in net earnings at the end of the day. So keeping that in mind, they've often done very well. And so I have to know at the end of the day that they may not be interested in staying on because they have enough cash in the bank, or they might be interested in staying on because they have one aspect of the business they like to be able to participate in, or whatever the case may be. But at the end of the day, like if the goals are the same and I'm trying to close, we look for business owners that are facing what I like to call the 3Ds: death, divorce, and disinterest. And if they are facing those three things, they're motivated to get the deal done at the end of the day, and we can come up with a structure that works for everybody. What's challenging is when they say, "I've made a bunch of money over the years. I want a big exit, more money on top of it, and I want to control all the terms of the outcome." And if you do all of those types of things, it can be very challenging for us to find something that works for everybody. And that's really what you end up doing. You start at two different points and you kind of negotiate your way through to get to a point where everybody feels good about it at the end of the day. And so to answer your question, in some of those cases, it's yes, stay on for 3 weeks, 3 months, 3 years. It just depends on the circumstance. But I'll say one thing that's really key about our thesis is the skill set that was necessary to take a business from 0 to 7 figures and a thing that takes it from multiple 7 figures to 8 figures and beyond is a different set of skill set. And I think that's
Sure.
a big selling point from our perspective to the business owner to say, hey, we're ready to take on the baton. You've done an excellent job. Let me show you what that would look like. We provide examples, we provide real case studies of how we've been able to do this. And subsequently, they feel more comfortable with, hey, my employees will be in good hands. Because that's what they don't want at the end of the day. If they really are a business owner that, aligns with a lot of what we think about, they want to take care of their employees, their customers, their vendors, so on and so forth. That once we can communicate, hey, things will be stable, we will do this. Um, we ultimately give them a lot of comfort along the way.
No, I mean, I think that's great. And, as we talk about some more of these finer deal points, Malcolm, by no means are we representing that you guys do not do those sort of things,
Sure.
for there. But, in some of the deals we have, some companies are buyers of companies. Are a little bit of a different approach. You have a very unique thesis, which I think is great, but some people are out there just rolling up different free cash flow businesses, and they don't want to operate. There's a great
Yeah.
operator, there's not sophistication, and so there's sometimes some shared upside that
Yeah.
we see in different deals that are out there with other type of companies, maybe through what we call an earnout, where
Yep.
there's a percentage of the purchase price that is paid over time based upon hitting certain net revenue figures, sometimes gross revenue, most of the time net revenue figures. We see things like phantom equity, or even rollover equity, where somebody gets to participate. And I know that's not what Tsetserra is working on, but just to make sure people know, there's a lot of different ways that a quote unquote purchase price of selling your company, the value you get, can be structured, which is important to make sure you get an attorney involved if you start
Yeah.
getting real complex on those, because the details matter. Let me
No,
let me move. Oh, go
just
ahead.
I was gonna say, just to speak to that, I completely agree with you that there's a million ways to skin the cat. I think one thing that I like to say for the audience is there's two things you can negotiate. You can negotiate total price and you can negotiate the terms. And in some cases, if somebody wants 5 million bucks for their business and I think it's worth three, the terms will look different than if they offer three, and so on and so forth. And so all that to be said, we have been in circumstances where we have offered some rollover equity at a minority position, knowing that they will play a vital role in a certain aspect for a certain period of time, giving them liquidity in the future. Or to your point about phantom equity, they get to revenue share with us for a certain period of time in a certain aspect, so on and so forth. So we have definitely got creative. We like being creative on deals. I think it helps us get the deal done faster potentially. But I don't want to miss the point that I think there's two things you negotiate. You negotiate total price, and that affects what terms you can negotiate, and vice versa. And when you figure out that with the owner about what they're ultimately wanting, then you can kind of get down to the minutia of how do we make this work where we're de-risked because there is an inherent risk to when these businesses transition, and you also walk away with a price that you feel good and your employees are taken care of and everything that you cared about.
No, that's absolutely right. And one of the other parts of this, from the buy side, is sometimes the sellers you know, we're far apart on what buyers price is and sellers price is. And when you get to that point, the creativity can come in like an earnout that says, well, if I disagree, if you're here, seller, and I'm here because I believe the values are different,
Yeah,
well, if we can set a structure in place that like an earnout that says, okay, you'll get that price if your assumptions are true with regard to what you believe it's going to do on the upside, but I don't have to pay it all today in
sure.
order to try to bridge that gap. There's some creative things that can be done. Not anything that we can educate everybody on in about 15 more minutes, but again, it's something just to understand. There's more than just a straight purchase price.
Yeah.
Let me ask you and kind of move to the scope, and just kind of a real quick on an asset purchase versus a stock purchase.
Yeah.
And again, we could go into an entire, other discussion and 30, 40 a minute discussion about it. But just to level set for our listeners there, in an asset deal from a legal standpoint, we're selling out of the seller's entity all of the assets to the buyer into their entity. So when it comes to furnitures, fixtures, hard assets, equipment, machinery, intellectual property, maybe even the assignment of key contracts, customer contracts, et cetera, those assets move from point A to point B. In a stock deal, what we have is we have the ownership of the company that's being sold to the buyer, such that the buyer is now the holder of the ownership for that company. We as lawyers always prefer, as a buyer, to buy the assets because something called successor liability. Check our social media. We talk all about successor liability follows you. But some people want actually, the stock from a roll up standpoint. What is y'all's thoughts on stock versus assets deal in the market you guys are looking at?
Yeah. We typically we typically want asset deals for a lot of different reasons, not to get into minutia. But one of
Right.
the things that's unique about the stock deal side of these deals is a lot of them, because they are family owned, founder owned, is they have very little liabilities typically on the business at that point, comparatively. And so, that gets us a little more comfortable. There's a tax incentive for both either side for each person. So not to get too much, that's maybe the topic of this conversation, but yeah, there's value in seeing it both ways, and it's still like I still think that becomes part of the negotiation side. So our preferred is obviously asset to reduce any liabilities from our end, but knowing that in many cases with a business owner, there's also possibly very little, and there's ways in the reps and warranties to protect yourself from all of that too. So
That's right.
it just depends on the circumstance. Again, it's part of the negotiation process. You know, I know that one of the things that we have to do, and sometimes is missed in the communication, is educating that there is a tax implication to which direction you go for the business owner and the buyer. And so we're constantly trying to educate and have a conversation and explain kind of what's the net outcome for everybody involved in this. And then, ultimately, does that align with what everybody's goals are for the business? So, anyways, all that to be said, that's way about it. I personally like an asset deal. It's often cleaner, but it's not always the case.
Yeah, no, I can't tell you how many times I have to explain to clients because again, knowledge going into these is power. That's why we
Sure.
do what we do here, right? What is an allocation? Well, why do I have to decide what an allocation is? And I'm like, well, because there's going to be a tax bill
Yeah.
that comes from all of this, and we've got to allocate certain things for both the buyer and the seller and those sort of things. So, no, I think that's great. And again, more information on stock versus asset, look at our social media on that because we talk about those type of educations. From another just key concept, and I don't have too many more here, is restrictive covenants. And
Okay.
restrictive covenants are a covenant is promise, and these are promises that restrict somebody. Usually, the sellers, right, are the ones that are subject to those restrictive covenants, and we think about those in terms of confidentiality, non-compete, and non-solicitation.
Yeah.
How do you guys view those as a buyer? Important, not important? What do you think?
Definitely important. It's not always just because of the people that we tend to go after or the business owners that we tend to interact with. It's not as vital because they tend to be out of the business to some extent, or they're way out of the business to some extent. I think one of the biggest ones that we run into is because the owner was in the middle of the business and had these key relationships. What does that look like post on the solicitation side? I think that's one that we have to struggle with. Kind of, hey, maybe they go over and they start a smaller business that's maybe unrelated, and they've got somebody from a skill set perspective, and they say, hey, Johnny, why don't you come over? Or hey, let me, you got that deal over there. Why don't you come bring the deal over here, vendor? So that part's a little tricky, because we do have some business owners that we interact with that have that kind of disinterest category, and they are often going and doing something else that's slightly unrelated, slightly different, or that it's something in the market but not directly competing with us. And so that's a very blurry line where they end up soliciting, some of our key guys, or key vendor relationships or anything like that. And so that's the one that we run into the most. Other circumstances might, we might come across those in the future. But that's the one that I always kind of think about, just with our demographic of sellers that we interact with.
No, I mean that makes sense, and there's the topic has died down a little bit, but non-competes.
Yeah.
I'm sure you run into this. I run into this too. They're like, well, non-competes, they're not legal. Well, in the state of Texas, especially when it comes to selling your business, they are very much legal
Yeah.
from a non-compete, because you're getting value for that business, and the courts say what you negotiate, as long as it's within the realm of reasonableness, which there's a lot of room on the business acquisition divestiture side, they're there. Now on the employment side, that's something that from a federal level, we could have again a whole nother conversation about.
Yeah.
But it's something that surprises people sometimes about these non-competes, non-solicitations, even for people that are going to be working in the business going down the road, going, well, wait a minute,
Yeah.
my relationships are my relationships. And
Yeah.
the reality is that's correct, right? But your relationship based on your company's relationship through you're selling. So
Yeah.
that's where the buyer is absolutely right to ask for those sort of things. Are there any other key concepts out there that at the term sheet level? We'll talk about more about a term sheet in just a second. But are there any more of those kind of key concepts out there that we haven't discussed that you guys see as something that's a constant conversation?
Not a bucket of information, but I like to be very forthright in the discussion. I never want to be in a position where we get under due diligence, proper due diligence, and then we're beating them up by things that we find. So I try to be incredibly forthright and say, here's my best offer. I think this is reasonable. I think we can work with this. Maybe there's a little ebb and flows in it on things how they shake out, but not a big variance. I don't like playing that game. There's a lot of other folks that end up doing that, and that's their prerogative. But that's not really what we like to do. We like to be real straight shooters, going into the business. Here, we have a very good understanding because you've shared at this point quite a bit with us, and then we can ultimately, walk away like we're doing it as we did it at the term sheet level. And so, anyways, there's not a big bucket, but I like to shoot it real straight. And so when we send out our LOIs or our term sheets, they have very clear expectations on like what we're looking for, as well as what the overall terms will look like, and they should not vary too much from that.
Well, and that's great. I just in my which for our viewers, what Malcolm's saying right now is, a term sheet when you get that is a piece of paper which is usually non-binding. This confuses people. You can have non-binding binding letters of
Yeah.
intent as well, which basically means all the deal points are non-binding, but maybe there's things like lockup provisions
Yeah.
and some others, confidentiality if it's in there as well, that is binding. But what he's getting at, and there's a rub on this, is when you get that down, it's supposed to be the business understanding of the parties, which is the go forward. Now I experience and I experienced it actually in my former life at a big law firm, where that number was rarely the number that you actually closed at.
Yeah.
That number was actually just the beginning of round two of negotiation, as the deeper diligence and, oh, I didn't know this, even though you could prove they did know this at the time they had the letter of intent. And so it just becomes basically a pause in the conversation, or the
Yeah.
negotiation for round two. In the small and medium sized business, I do find, a lot out there that the term sheet is largely the actual definitive a business proposal that's out there, unless there's something that just wasn't known. I mean, that's just something that I see. I mean, I have run into a couple of sharks that wanted to knock it down, but it's important to know that these things are non-binding where we put
Yeah.
these key terms out, because at the end of the day, until there's a definitive agreement signed, which is what it usually says in that term sheet, the parties aren't bound to do anything.
Yeah.
And that can be something that can become a surprise for people as well on both sides, on the buy side and on the sell side. What are your thoughts on those term sheets?
Yeah, I think you're right. You brought up a really good point about the binding versus non-binding segments of a term sheet and how those kind of are structured and written. One of the things that is really important for me, when we're focused on doing this, and again, we're a small shop, so keep in mind, like, there's different groups that handle it differently, but I like to be very clear on the exclusivity aspect of this deal as I'm going through it. So once we've gone through it, there is some explicit language regarding exclusivity for a period of time, because the worst feeling, and it's happened, the worst feeling is when you're going into a deal and it's maybe a competitive process, or that person's gone to market a little bit more. They've signed with you, but then all of a sudden you find out that they're still talking to another potential buyer, and kind of how that feels. And the worst case is they're talking to another buyer and their employees know. So that becomes even more complicated. And I've been
Yeah,
there.
I'm
So
sure.
it's not a great feeling for anybody. So that's one that's hard. And I think being able to communicate, again, sophistication all around is always helpful with us trying to get to the end goal, being the same end goal. Being able to communicate what is binding, what's non-binding, what's some breakup fee aspects, all these type of things matter, so that there's not some lost expectations along the way. Because when that term sheet is signed, there is a bit of a clock that starts ticking, and when that clock starts ticking, like, everyone's invested, ultimately to try to get the same outcome. There's different ways that we go about that, and we also want to be respectful of the fact that we're still in the kind of the courting phase per se, right? It's not a the deal's not done. We're still in the courting phase. Things can still break up, but at the same time, there's some real questions that have to be asked and some things that have to be respected, so everybody gets what they need from the process.
No, I mean, I think that's great. And again, on the buy side of a transaction, I mean, look, my clients have to expend a whole lot of money, time to, for a deal that might not get done. Because if a definitive agreement doesn't get signed, that's a sunk cost for them.
Yeah.
And so that makes complete sense. What I tell my clients on the sell side, meaning they're selling their businesses, look, if you are selling your business and you're presented with a term sheet and everything in it is non-binding, make
Hmm.
sure that you have a business understanding between you and the other party, and we can take a quick glance at it, but at the end of the day, it's non-binding, move forward. But if there is any term on there that is binding, you really should have a lawyer look at it, because
Yeah.
there are things that people, I mean, I've been on the deal where somebody didn't realize there was a breakup fee, and a breakup fee says that if the deal is not done during a certain time frame, you have to pay the other party that money. And if you look at it from, a buyer's perspective, look, I'm about to have my accountants come in here, and my HR team come in here, and my IT guy come in here. I'm going to spend 20, $30,000, and if we can't get a deal done, that because we think we're that close for whatever reason, you can reimburse me for my costs. And I've had
Yeah.
clients that have signed those.
Yeah.
So there is a trade-off of that risk and allocation at the beginning. If everything's non-binding, most of the time it's okay to just kind of keep moving through that process. But if any of it's binding, it's really important to make sure you understand what you're signing, because it can surprise you down the road.
Yeah, absolutely. I think one of the ones that we run into the most, and I just want to speak to your audience, that those that are sellers, it's an invasive process to go through due diligence. It really is. Things that you didn't anticipate, or questions that get thrown at you, because it's a total different lens being looked at your business, and you've been doing it for the last number of decades and years, and so on and so forth. You've got a different lens looking at your business, at questions you've never been asked before, and it can be very invasive. And so one of the ones that we run up against is the withholding of information. So we do try to communicate, through our LOI, is like, if you withhold information, you're extending the process, thus extending our costs, and really just opportunity costs for us, by and large, if we're spending here, and you won't even give us that information. So we've been tested. I told you earlier, I've signed 3 different versions of NDAs during due diligence, because people just didn't want to give up some information. And
Right.
so all that to be said, once you're under that non-binding situation, yes, you're privy to run the process how you want to, but it would be behoove you to not want to participate in a collaborative way, because it ends up just being a long-term, kind of kerfuddle for everybody.
No, that's exactly right. And to that same extent, I mean, I've had let's just say I've had some clients in the past that said, "Well, I'm not going to give it." The reality is, when you get past this term sheet to the definitive agreement and a purchase agreement, there's risk allocation. So that is that thing that you think, oh, if I just don't tell them,
Yeah.
let me tell you, the way the formal process works, your secret is sitting probably to burn you,
Yeah.
not of something you're going to just walk away with in the risk allocation of that, or it's going to get disclosed because a guy like me is going to be like, sorry, we got what's called a disclosure schedule. We're not
Yeah.
making a false representation. You got to put it out there, at which point in time it blows up later. So
Yeah.
transparency again on that. And it's, deals are kind of wrapping this part up. And I know we're going to have you back for a second part to talk about a definitive agreement, but the collaborative nature of these transactions, I love. But at the same time, let's not say that, these aren't very, these can be very contentious, even though they are collaborative, because at the end of the day, the hope is that the buyer and the seller have found mutual ground to do a transaction and are relatively happy with that
Yeah.
transaction of what they're doing, which is unlike as a lawyer, any other process like going down to the courthouse, where usually at the courthouse, maybe one person's happy with what a judge said, but usually everybody's upset about something at the end of it.
Sure.
It's not the case for deals. How do you look at collaborative processes for this? Like, what are your thoughts on that?
I sound like a broken wheel. I apologize. I think the
That's
collaborative
okay.
process is being able to know that you both have the same goal at the end of the day in mind. And you might go about it slightly different. You might be asked questions you never wanted to have to answer. But by and large, kind of switching to our second segment at some point, um, you know, there's ways for me to de-risk at the end of the day when I'm buying these businesses. And so, in my reps and warranties and holdbacks and all those things that I kind of have at my disposal, we will be protected. You're often better off not being in that circumstance and solving the issue ahead of time, or again, just not keeping something in the closet when we're getting closer and closer and closer. It just becomes a challenge. This most recent business that we bought, all of a sudden there was like warranty issues, and I was jumping on a plane to somewhere far away like the week after we closed. Like no one told me that there was this warranty issue until we closed. And so there's ways for me to de-risk. I will always want to de-risk because I have the vested interest of making sure this business exists in 5, 10, 15 years. So as a
Right.
result, I've got to de-risk the process. You can't walk away with a bunch of money and then ultimately the business just crumbles because there was this kind of, weird thing that was happening in the background that no one talked about. And so anyways, I that's our interest. I really do believe that we want to take care of these employees. We want to take care of the honoring of the name of the legacy of the owner that previously had built it. And so as a result, I'm going to de-risk in the process through, the means that I have available.
Well, that's great. And Malcolm, you're going to be coming back with us here to talk about that second part where we get to how do you get the deal actually done. This has just been talking about the beginning. I really appreciate you coming and sharing perspective again, because I don't think, small, medium sized business owners don't talk and understand this enough. So I can't thank you enough for coming on.
Yeah, my pleasure, Matt. Thanks for having us.
Great, great. And we'll catch you in the very next episode when we talk about getting that deal done. For those of you that are watching us on YouTube and on a live streaming, click that subscribe button because, as you can tell, we like to make sure that we're educating and supporting our small and medium sized business community because the goal for most companies is to eventually sell their company so that way they can make that big exit. And as you can see here, the education, the details, and the process, it's important to know that and will make you a better negotiator in understanding what that means. And here at the South Texas Business Lawyers, again, our goal is to educate, support, and advise every startup, small, and medium business in the state of Texas. And we hope that you have enjoyed this podcast, the South Texas Power Lunch. If you're listening to us on Spotify, Apple Music, any of our audio sources, click subscribe so that way you don't miss the next episode. And don't miss Malcolm because he's coming back to talk about even more of the details about how you get that deal done for buying or selling a business. We'll see you next time.